back to the Capital Mindset Show. We're your hosts, Austin and Fabio, and today we are going to be exploring Boeing and Airbus. There's been some recent developments in both of these two companies, as well as we're going to be kind of doing a quasi-preliminary analysis. We're going to be exploring the company. We're going to be exploring the financials. We're going to see the story the financials are telling us, et cetera, and so forth. So without further ado, what are we looking at here today?
So I'll let you pick, actually. What do you think we should do first, Boeing or Airbus? Because we're going to do both in this video.
I think we should do Airbus first.
You think we should do Airbus first?
I do.
Okay.
Let's do it.
All right. So if we take a look at Airbus.
Also, let's kind of talk about what is Airbus? What does Airbus do as a business? And then also let's kind of explore sort of the airplane economy that exists. Like, I have a couple of questions. For instance, do airlines buy these planes from these airplane manufacturers? And then from there, does that kind of play into the brand reputation of these airplane manufacturers as well as these airlines? Obviously, I mean, just sort of intuition tells me that it does, but just sort of a deeper analysis. Is this something that customers or consumers care a lot about in regards to these sorts of things? If that makes sense, what I'm asking.
Well, actually, we can allow the audience to comment down below if they care about what plane they're flying, if they really pay attention to that. I don't necessarily do that, but I know some people may do that. I do think that to answer your question, yes, the airlines actually pick the planes, obviously, because we are their customer, and then they are the customer of these airline manufacturers or airplane manufacturers. So Boeing and Airbus are both the largest airplane manufacturers in the world. And we're going to be focusing on both of them today and kind of comparing them. But Airbus in particular is the one that is perhaps, I think, catching up or surpassing Boeing at this point. They just had an air conference where they basically showed off the new planes, and then they successfully got a bunch of orders. So we know that, for example, Delta and a couple other airlines are basically exclusively now going to be using Airbus, or for the most part using Airbus. And this is actually done because of the reputation damage. And actually, I'm going to go against you, Austin. I think we should go Boeing first. Because
really?
we should discuss that problem that Boeing is having before we actually discuss Airbus. So real quick, a little bit about Boeing. So Boeing is the largest American company in regards to manufacturing airlines, and was regarded as the most prestigious in the world for a long time until they destroyed their reputation with the 737 MAX. And if you know about that plane, you know it for the wrong reasons, because unfortunately, a lot of people lost their lives in that plane. And that was because of some design flaw and with some software that was basically, or some system that was basically pushing the plane's nose down. And the current CEO is the one who was under watch. You know, he was in charge during that. So it's up on, the onus was on him to make sure that that didn't happen. And it did happen. So already management is in the penalty box for me. And the company with middle management who was in charge of that project is also in the penalty box. So I have a lot of trust issues with the reputation of this company. So without further ado, I think we should look at the numbers, and a little bit of a spoiler alert, they have absolutely destroyed their balance sheet. And we'll actually talk about Airbus as to why that's not the case with Airbus. So real quick, I want to showcase some new features that should make it easier for our audience to keep track of things going forward. We will have this new little charts that show up, and it's automatically created by the model. Basically gives us the sales to visualize and the cash flow, so we can just see that, right? And we also have this little message that I'll get over soon enough.
we should look into why that's never mind.
So we should see the discount rate of 15% plugging in Boeing, and you're wondering why it's 0, right?
Yes.
Well, if we take a look here,
there's more.
Well, wait, there's more. So it's a negative cash flows right now. So basically, we have to normalize the cash flows, or we have to tell the model what we want in the cash flows over the longer term in the recovery period. So basically they take about in the conservative measure, about 15, not 50, sorry, not conservative, aggressive. So if we say they're going to get back to original levels, 15% is where we're at. And we're discounting it now at 15% required rate of return. And we need to actually check these growth rates. So look at this. We see the average growth rate of the past years is -6%. We're obviously not going to assume that they're just going to decay forever, right? Because watch this. If I were, for example, follow that, we say -6%.
Yep.
Obviously, it's going to do that. And we need to be cognizant, right? Because the problem with sometimes looking at numbers is you're caught up in the past. And even though I expressed some negative sentiment about Boeing in the beginning of this video, I don't want to let that bias, get ahead of me, right? And so I'm going to actually take it seriously when I look at the numbers. For example, the buybacks, are they doing the buybacks? Are they diluting me? Are they going to do that going forward? And then also take a look at the growth rate of the past year. So actually I want to see, so in all, they have actually bought back 0.11%. Okay. So that's to show you how many buybacks they were doing before, even though they basically absolutely annihilated a lot of those buybacks over the past 5 years. So basically they ruined a lot of the work they did. So let's go ahead and assume going forward, they do some buybacks, but they do at 0.11%, because as we'll look forward, that's 11%. There we go. We are going to see the balance sheet destruction. So before we continue here, I actually think we should look at the health of the business, and then we'll come back here and talk about these growth rates and our assumptions.
Well, I mean, even looking at the discrepancy between sales and cash, for those of you who might not know or might be new listeners on the statement of cash flows, net income is the first line item, and then it's reconciled through the non-cash expenses and then changes in assets, and then it comes out to total cash from operating activities. So that kind of means that all of the different financial statements are really interrelated with one another, which is exactly the canvas that allows us as the investors, the artists, to paint on. Now, I know some of you might roast me in the comments for saying that and say that what I just said was stupid, but it's true, and so kind of taking a look now at this company, when I saw that discrepancy between sales and cash flows, I immediately kind of thought to myself, maybe there's potential scalability issues here. Now, that's kind of what I like to look at when I look at an income statement. I like to sort of look for scalability issues. And the biggest ways that I could really tell that are the gross profit margin and then the operating profit margin. So what is your opinion? Do you think that this company potentially has some scaling issues going on here? And then if so, do you think that this might continue to perpetuity, or do you think there might be a time period by which this might rectify?
Well,
and then
Austin, I don't want... well, I'll just say nuance is important. What company are we talking about?
Yeah, it's Boeing. Yeah.
Do they have scalability issues?
No.
If they did, yeah, we would have seen the problems a long time ago. The problem's not scale. The problem is they messed up,
Yeah.
They messed up, and then there's a whole problem with messing up in terms of reputation, et cetera, et cetera, et cetera. So I don't think they have a problem with scale.
No, probably not.
Yeah, probably not. Airbus and Boeing, I can tell you right now, pretty safely, they do not have a problem with scaling. That's a question we'll ask for non-profitable companies that are just new. And because they haven't proven themselves to be scalable. But all these legacy companies, they've proven themselves to be scalable already. So we don't need to ask necessarily that question. Now you can say, is their industry being disrupted by some AI airplane? It's just a joke. And then this AI airplane is just flying people,
Yeah.
And it self-replicates. So it doesn't even need a fact. You see what I'm saying? Like that, then you can say, okay, do they have a problem going forward in terms of competition, et cetera? But in a company that's like a legacy, blue chip, stuff like that, those kinds of questions. But that's good that Austin brings that up, because you may ask that, and then you gotta put in the nuance, and then you can kind of figure out when to ask this question, when to ask that question. So what we want to see here actually is what the heck's going on with the balance sheet? Because you see here the long-term debt ratio. Look at this absolute destruction. Now we can see here from 2020 to 2021, they're bringing that down. That's a good thing. But remember, when you take on all this debt, what you're doing is you're borrowing from the future. And what if your competitors aren't doing the same thing? We'll take a look at that in a second, but the answer is it can put you in an unfavorable position with regards to that competitor. And that competitor, if they beat you on reputation and they have more capital, they have a more flexible balance sheet, they can perhaps leapfrog you into the next generation. And that could be a problem, okay? If you're not able to recover that reputation and you're not able to make the necessary investments to compete in the future. So remember, we're looking at the balance sheet in its current form, but you have to derive from it the story going forward, right? That's what a good investor can do. Anyone can just look at the balance sheet and say, oh, these are the numbers. But if you're not able to take that nuance, grapple with that, and then extrapolate from that something going on into the future, you're not going to essentially make a good decision when it comes to investing. You may, for example, when we get to this in the actual predictions for the model, you may make the wrong assumptions, right? So here we can see the gross profit margin. So if we were looking at scalability issues, we would assume something's going on, right? But I can tell you that they don't necessarily have scalability issues because we see what they did before. Right now it's one-time events, supply chain issues, reputation loss, order loss, etc. But we know that the industry itself is growing and there's not many players to supply planes. So they may be able to bounce back from this. They may not. We don't know. But we do know that there's some damage going on to the company. And we can see here in the margins. So in the margins right here, and then if we take a look at cash flows, well, cash flows are negative too. They're just bleeding cash. So in order to sustain everything, they're having to take on this debt. And remember, like I always say in a lot of these videos, a good investor can derive a story, right? The numbers are just numbers. And so this is where Austin's kind of like appreciated this, is that, and I'm coming from Love from the accounting and finance background. So it's no hate towards accountants, but sometimes it can seem that way. But accountants are good at compliance and looking at the present, but sometimes struggle in the extrapolation process. So you don't want to assume stagnation. You want to be able to take the numbers and then kind of give a narrative, right? So the numbers are telling me all that I need to know for the most part in terms of the present. It's telling me a story about a company that is some event going on, causing a bunch of problems down the income statement, and then they're having negative cash flows, and in order to survive, they're having to take on a lot of debt. Okay, so and then we can take a look at the inventory numbers, get an idea of what's going on, and yeah, basically right there, this is absolute destruction. This is terrible. We're supposed to be going down, and we doubled from 2018. And also, what are the numbers telling me here? Well, the numbers are telling me that the problem started occurring between 2018 and 2019, and then got worse in 2020. Something happened there. I wonder what happened. And then the problem is persisting, right? It's getting worse in 2021. This is not good, because that's for the future. Remember, if we just look at the numbers stagnating here in a stagnant picture, we're not going to be able to properly derive future assumptions, which is all that investing really matters. Because sure, you can look at the past, but you're not investing in the past, you're investing in the future. So then asset turnover, everything's getting kind of worse across the board. Accounts receivable turnover, terrible. Yeah, they're basically right here. This is telling me they're losing their power with the customer, right? Now, maybe a little cringe, but I guess they're calling the airlines daddy now. So yeah, not the other way.
Dude. Wow.
Not the other way around. No, because I remember.
So actually,
it was the other way around. Long time
something
ago.
I'm kind of curious. You brought up the notion of the cash conversion cycle, and you kind of brought up this narrative that like they could bully the et cetera, so forth. Would you kind of explain that a little bit? What you mean when you in regards to the cash conversion cycle?
Like why they're calling the airlines daddy, or?
Yes. Yeah, basically just elaborate on that further.
So the cash conversion cycle is often indicative of the power that the company has in its relationship between the customer and the supplier. So we did videos in the past when we showcased a bunch of food companies, and surprise, surprise, among the food companies, PepsiCo had the best cash conversion cycle, right? And we compared a bunch of different companies by size, but PepsiCo, being the largest, had the greatest cash conversion cycle, and then the smaller companies had worse. They had higher cash conversion cycles. So that's all that's saying. It's the time it takes, right, for the inventory being sold and the accounts receivable for them to be paid for their cash conversion. They're converting the accounts payable, receivable, sorry, and the sales, right? Their sales are converting to cash, because I can sell you an item and I might not receive the cash for a number of days. So the longer that it takes, typically that is indicative of having less power. Now, this industry, I want to be very clear to the audience. You can see here in 2018 when Boeing was, kind of at the top of their game, or somewhere close to the top of their game, it was 266. Now it's 495. So 266 is considered high. So if you remember the food videos where we showed PepsiCo,
it's like tiny. Yeah, it was like
tiny. It was really tiny, but everything with nuance. Why do you think that is? Well, this is planes we're talking about. This isn't chips. This isn't snack foods. This is not a grocery store where there's people coming in every day and buying it. No, these are relationships that are occurring with airline companies that are buying batches of planes here and there. So the cash conversion cycle is naturally going to be larger, but you want to pay attention to this, and we'll look at Airbus after this. So it'll be raw. I haven't even seen Airbus. I have not looked at Airbus because I want to showcase to the audience always like the process. Yeah. There's a process to it. And I seriously did not look at Airbus. So if I'm looking at Boeing right now, I'm going to look at Airbus next, and then we'll see if it's better or worse. So, but in isolation, we see it's getting worse. So it's telling me a story. It's telling me that something's going on. Probably the relationship between their customers are deteriorating. If I see Airbus having the same problem, then I know that that's industry wide and not just an isolation of Boeing. But right now, based on the context of the situation, I believe that it's an isolation of Boeing. I can be wrong. And when we see Airbus, we'll find out. So going to the summary report, after everything we've discussed, we can kind of play around with what we think they're going to be able to do. And this is the recovery calculator. And the model is over here telling me, hey, you should probably take a look at the recovery calculator because this company is rather cyclical. That's just, it's doing its little analysis there. And then I just come down here and I want to see, when do I think it's going to reach that point again? And I can assume some growth rates. And this is where like the art meets the science. So this is like a crutch. It's not going to do the work for you. There's no,
it's just a nice base point, it's a nice place to start.
It helps us kind of put things together and say, okay, if I think it's going to recover, for example, in 4 years, then I think I have to assume a growth rate of about 12%. So if you can see that, let's do 12%. We can see right here, it's a buy. It's a buy relative to the discount rate of 15%, so required rate of return. And we are assuming a small amount of buyback. So if you can assume that, then fair game. Now let's actually increase our margin of safety. And we can see now that the assumptions rather change. And let's see, let's go back here and let's assume that the recovery period, so the more aggressive you want to be, the quicker the recovery period. So for example, if you want to say recovery period of 3 years, and then you think it's going to be perpetual, well, that's about right there. And we're still not there under the assumptions of a required rate of return 20%. I think because of reputation damage, I actually would require that from this company. I would not buy, and it's close, by the way. So let's be clear, it's close. I think, remember, I'm being aggressive with 17% because I'm assuming a recovery period of 3 years. So if you want to be more conservative and say it will take longer, for example, you can say we'll recover in 5 years and it'll be 10%. So a 10% amount, we can actually like plug that in. Let's remove that negative. So if I could get this
Wow.
at around $135, and you know what, I'll like I think the channel Everything Money did a video on this company recently, and I think that their Paul's statement was he believes this company is around a low 100 company, and the model's telling me that right now, under these assumptions. So if I want to be conservative in the recovery period, I want to be conservative in the required rate of return, have my margin of safety because of that reputation damage.
Yeah.
I would have to buy this thing at about $135, and currently it's at 209. So it's not a buy if that's what you're requiring from the business.
Yeah.
I think in the longer term, once it recovers, the growth rate will tend to be between it's going to be a big range, but between not zero, but like 1 and 10%.
Zero.
No, but 1 and 10%, because
Yeah.
it just depends on the market share that Airbus is taking, which actually, if you finish your closing thoughts, Austin, or what you think, we'll move on to Airbus. But I want to get to Airbus.
Yeah. I mean, I think this is definitely an interesting business that, not to sound like I'm completely scripted here, but I think the business it's a great business because I only see a positive future for airplanes moving forward, more people using airplanes as the world comes back alive, et cetera, so forth. So now the question remains, I need to do more extra research to just sort of see if we can even really apply those assumptions of like a 4-year, 3-year, 5-year recovery period to a company like Boeing. Because, and correct me if I'm wrong here, those sort of like downward cyclical trends, are those things that tend to recover quickly with well-established businesses in this particular industry, or is it typically a longer process for such things to recover?
Depends on what happened. That's the answer to that. That just entirely depends on the specific scenario that we're talking about. Was it PR? Did people die? Was there a permanent scarring, on the so like, if it's a PR thing, I think the studies show it's like 6 months. 6 months for people to forget, for the public to forget. And I think we've discussed about some companies, Facebook, for example, goes through scandals. People forget about it because the scandals aren't really anything that people are really serious about, because they continue to use the products, so it's kind of laughable. And other companies here and there, but like this one's, it depends. It's nuanced. It's depends on the context. So let's take a look at Airbus, and where we'll start first is obviously, let's start with the price. Everyone wants to see the price action, right? So we get an idea what's going on here. So we see here a year chart, 5-year chart. So 5-year chart, same thing happened here. As to Boeing, we saw a decline here and a subsequent recovery, but not all the way to where it was before. And over the long term, I mean, you've done pretty well since 2008. It's not going all the way back for some reason, but you've done pretty well for yourself. And you're basically taking the other in the duopoly. So that being said, let's actually go to the model here. And again, the model's suggesting we're in a cyclical downtrend. So it's asking us to go look at that calculator. And we can see the average growth has been negative 1.23%. Let's take a look at the buybacks. The buybacks has been, so we've had a small dilution as well. So that's interesting. So both of them have diluted us a little bit, but what I will point out is that Airbus did not do aggressive buybacks over that time period, unlike Boeing did, and instead has maintained a healthy balance sheet. That's a spoiler. I should have waited for the ratio, but I'll talk about it now. And so the sales and the cash flows, we can see. What do you notice here, Austin? What do you notice with the cash flows?
I'm noticing a pretty significant jump from 2020 to 2021 as of right now.
Go back.
What I'm also noticing too is I'm not noticing as much
Boeing.
of a discrepancy between sales and cash flows.
Well,
it seems
this is Boeing. This is Boeing again. Look at Boeing. Look what's happening.
Yep.
Look at Airbus.
Wow. Yeah. So they're much healthier. they do have a healthier balance sheet,
Mhm.
or at least they have a healthier cash pile. So
Yep. So before we talk about any of this, ignore these numbers. We don't know if these numbers are the ones we're going to keep. Let's go to the ratios. So do not rely on those numbers. We need to actually like do some more digging. So here we go. So very beginning, I'm just looking at this right off the bat. Balance sheet, stable. Look at that beauty. Look at that. Remember what Boeing's was? 40%, got to 40%. So this is telling me a story. Long-term debt to capital, it got worse, but see, it's much better than Boeing's. Debt to equity got worse. So the balance sheets did get a little worse. Okay, let's not sugarcoat it, but way better than their competitor Boeing's. And look at this gross profit margin. Look at that. That's really interesting.
Wow.
That rise.
That's much
nice.
higher.
Yes, exactly. So I'm a little more excited about Airbus, right? So this is what a little bit talking about this, we see the earnings quality. Earnings quality is pretty solid across the board.
Just a quick pause here, right here, maybe for some of our newer viewers. Would you kind of briefly summarize what earnings quality is?
It's quality of earnings.
Nice. Well, a little bit more than that.
So earnings quality is kind of the measure that I put into the model that basically takes the management's reporting and gives them a scorecard that tells me, it's a custom metric I use for myself that tells me whether or not they're, little fudgers with the numbers. Gives me a score on their accountants, basically.
Shenanigans happening here.
Yeah. And if I, and just by looking at it, it should like all average out over time, but it should average out around like 0 over time. But I prefer to have higher earnings quality or invest during my measures of higher earnings quality than of lower earnings quality. Lower earnings quality is signified by negative scores.
Mm-hmm.
So if you can see here, for example, the earnings quality, it was 4.78 in 2020. Well, in 2020 was also really low stock price. Gives you an idea.
Mm-hmm.
So it's one of the many metrics. This doesn't mean it always works, but it does work from time to time. It does help out with. It's just like a smell test, for example. So earnings quality is telling me that, and then the earnings quality is now this. So it's more desirable last year than it is this year. Make sense? Kind of.
Yeah. No.
Without getting too much into like the down and dirty of it.
I'm just absorbing it all. Wow.
Dang, look how much better that is. Look at that. They're just better across the board. Look at that. So we would have to see probably like the 10-year data, but yeah, they're just better. Look, they got better here. So 2018, 2019, we saw the deterioration for Boeing. You can go back in the video or just stick with us and just believe us that this is true. Yeah, you know what? I'll just go myself and show everyone. Let's show everyone. So right here, cash conversion cycle, 2018 to 2019. I forget, Austin, we need to be more vocal about what we're looking at. Describe it, because just in case our audience is, driving, they may not be seeing the numbers. But what we're seeing here is Boeing from 2018 to 2019 had a deterioration in the cash conversion cycle, which may be indicative of the problem that they could remember, deriving a story from the numbers. And then Airbus had an improvement during that time. So that tells me that's when Airbus gained reputation while Boeing lost it. So Airbus gained from Boeing's deterioration. And then Airbus is maintaining a rather strong cash conversion cycle superior to that of Boeing, even before the problem of the 737 MAX. So across the board, Airbus is superior in the activity ratios, or when we're measuring inventory and how that's being handled. And then again, to summarize, we had better earnings quality. We had positive cash flows. We don't have destruction of the balance sheet to the same degree, anywhere near the same degree as Boeing. We did have some minor share dilution, but I can tell you from the story that Boeing was the one that was buying back shares in the past and had to dilute a ton of their shareholders in the past couple years to kind of shore up the balance sheet, make sure the company could survive. and not go bankrupt. So, well, by definition, they weren't at risk of bankruptcy because they had options. So let's be technical. They weren't at risk of bankruptcy because they had options to raise capital. So that being said, let's go to the Airbus measurements. And we're being very aggressive here with some of these growth rates, okay? So let's be a little careful with how we talk about this. Return on invested capital, I actually want to point out, it's really good. Return on equity is really good. Return on assets could be better, but they're an asset heavy business. So I do expect that to be low. Book value, I don't really care too much, but if somehow you could get it at book value, that would be very cheap for this company. But you're not really, I don't think you'll get a chance to do that. And we have a PE of 20 and a price to free cash flow of 12.5. So it's cheap on cash flow basis. But keep in mind, it is cyclical. The cash flows can be coming in. For this business, Austin, I usually like to tell the audience that I love the cash flow statement and I have my problems with the accrual basis of accounting. But like with everything, there's a lot of nuance. In this company,
it's our favorite word here, capital mindset.
Yes. No, it is because in investing, there's so much nuance in each industry that you talk about. It just entirely depends on what it is we're going to be talking about during the day, that it will change entire points of view for me. So for example, the accrual basis of accounting, in my opinion, for this company and for Boeing, it's actually a better way to smooth out the numbers. It's actually beneficial to investors. So let me explain. So for example, right now, the cash flows, do you think they're indicative of the actual performance of the business?
I would probably say no, just
because of the way I'm phrasing it.
Yeah.
You'd be somewhat right, because it's the cash flow is measuring the cash coming in, but the cash coming in may be from previous sales that, remember, they weren't paying. Remember the cash conversion cycle? Remember that thing? So though that cash coming in, it's taking about almost a year. If we remember that number, it's like 200 days. So you're getting the cash of activity from 200 days ago. So the accrual basis of accounting is perhaps better measuring those activities, right? Because it depends on the way that you're recognizing the revenue, that whether or not you're the completed contract method, or the percent completion method. It just depends on how it is that's just two examples, for example, in accounting, how it can be separated. But the accrual basis of accounting in this instance is perhaps more indicative of the activities themselves, because it does take a while for these products to be delivered. Okay, it's different from another company. Other companies all say, no, cash flow is king. I don't care about the accrual basis. The accrual basis is more misleading than it is not. And if we looked at the earnings quality, it did give management a good score overall, right? So it does like as a smell test tell me that there's not shenanigans going on.
Yeah.
Okay. So for this business, I do care about that more. So I actually think the PE is a little bit better than the price to free cash flow if you're going to use one or the other. But that being said, it should average out over time. So when we assume our growth rates, it's still fine because we're smoothing that out. We're taking like the compounded cash flows and just like averaging it out. So taking a look here at the recovery period for the cyclicality, if we assume a 1 year recovery, that's 24%. Is that possible? Perhaps. Likely, maybe not. So I'd probably rule that out. I'd say it's going to recover in maybe 2 years. I'd be comfortable with assuming 2 years, 2 years or more. So let's cap it out at, let's keep a 1 year just for the sake of it. So let's do 24%. Of course, it's going to be a crazy buy, because then we're extrapolating. Remember the assumption with that saying, we're extrapolating from that it will continue to grow at 24%, which is probably not likely. So then if we take out the recovery period and we say, okay, it's going to recover in 2 years and get to 11%. That's still kind of aggressive, but perhaps more doable. Okay, perhaps more doable. And we can kind of see, for example, let's take a look at Seeking Alpha and see what they kind of say here, right? Just as an example, you see here that they're saying the forward revenue growth rate is actually negative 4.3%. It's 3.4%, sorry. And the current revenue growth rate is 0.8%. So for Airbus, maybe the reality is going to be a little bit less, a little bit more. It depends on you. So you do your research and then you come to terms with what you think the growth rate is going to be. But you want to remember, in this case, we're trying to smooth it out over the course of 10 whole years. So I'd say I'd be comfortable with this business, right? Let's be conservative and let's say the recovery period is 7 years. And then I'm comfortable with smoothing that out and saying 3.16% over the course of many years. Let's say that. I'm comfortable with that. So at basically what this is telling me, at $83, I believe that the company can be a buy relative to the required rate of return of 15%. And then if you want to go a little more aggressive, so again, I don't want to assume 17 or 30 here. I want to get us a little bit more nuance there. So say like 5% and 7%.
Yeah.
So see, with 7%, we're getting a little close. So if they can achieve 11%, you're in business, right? And they may achieve 11% because what those numbers on Seeking Alpha do not maybe account for is perhaps the market share that they're taking from Boeing and the market share they will continue to take going forward. And perhaps there is a misjudgment on the growth rate of the industry. Okay, but that's just to give you an idea of the thought process. So actually, what did we find out here, Austin? There's something we kind of found out about Boeing and Airbus that I just found out. What did you find out just now?
Well, at least like by what I've been seeing, I'm seeing one company that's pretty healthy and then another company that's deteriorating to sorts right now because of some recent developments that have been taking place. So that's basically what I'm seeing here. I'm seeing two companies in the same industry, direct competitors. One company is a superior business to the other company at this present moment.
Yep. However, what's interesting about Boeing is that Boeing is seemingly a little bit cheaper. Depends on how you look at it, but cheaper perhaps for good reason. Cheaper perhaps because remember, if we go back to here, and our audience might have caught it, and I just caught it just now, right? Because again, this video is just raw. It's just we didn't make any prep. We never really prepare for any video. We just let it go raw. But I discounted Boeing at 20%, and I still, like, for example, actually, let's go back to the 15%. See, at 15%, I can assume these different growth rates, right? And this is assuming these different recovery periods. Boeing has more to recover. So, and actually, I just might double correct myself. Yep, I'm going to double correct myself. No, Boeing is actually more expensive than Airbus. Okay, so so the audience can kind of see here, again, this is raw analysis. I'm looking at here and I'm assuming, for example, similar growth rates. And remember, they're part of the same industry. They are competitors, right? Boeing does, I think, do more things than Airbus, but within the respective industry of selling airplanes, they are competitors. So presumably they will be both benefiting from the industry growing as a whole. However, one may take market share from the other, and I would think that Airbus would over Boeing. So while I was thinking for a second that Boeing may have been cheaper, but actually when you adjust for growth rates, assuming, for example, the same growth rate, I think Boeing, let's actually do 11%. Oh no, Boeing's divided 11%. So there you go. You're kind of seeing the market's kind of pricing them almost the same. That's what that's telling me. And maybe that's not supposed to be correct. Well, actually, I'm assuming these buybacks. Let's equalize it. Let's not assume that buybacks. Oh, well, it's probably going to say no. Yep, nop. Yeah. Wow, look how close that is. Look exactly what it's priced for. Right there. Yeah. But I'd be very comfortable with, like, assuming 11% or less, because I'm giving it 11% averaged out because I'm assuming the recovery period, then plus the perpetual growth. So, we're assuming that the industry as a whole recovers. So 11% is kind of like my sweet spot. But I'm very comfortable with assuming, for example, I think, what was it, like a 5 or 6% that I had on Boeing?
Yeah. It was.
Let me remind myself. I think
it was about that.
Well, actually, no. I think I used this calculator here. I think it was like 4. Yeah, 4 or 5. Yeah, so I'd go with 5. I'd be very comfortable with assuming just a 5% growth in the cash flows over time. And then if we, again, for Boeing specifically, the reason why it would require a greater margin of safety is because of that balance sheet risk that they just destroyed. No, yeah, it wasn't 5%, but it's around a little bit above 5%, because I think 5% is a little bit too much, because I'm assuming the recovery takes 10 years. I don't think that. I think it should be like, I think the recovery safely, we can assume it's like 8 years, or like 7 to 8 years. That's pretty safe assumption. I think obviously it'd probably be sooner than that. People in the comment section might be saying, oh, it's 10 years, nowhere near that. So I'd probably say, yeah, about like 8 years. Well, sorry, I keep saying 8 years, 6 to 8 years. So if we assume 8%, a lot of things are going through my mind right now. Because obviously we're doing these videos, and then we're seeing, oh, does this interest us for my portfolio? Maybe. So between the two, we got to give our audience a conclusion. I think they deserve it. If they stuck this far, they deserve us to kind of give our thoughts here, because we just went through Boeing, we went through Airbus. We're seeing what the companies are offering at their current price. We know they're both blue chips in their respective manner. It's kind of like a duopoly between them. All right, Austin, you must make a choice. Boeing
I have
or Airbus?
the gun to my head right now.
Yes, you
I
do.
would have to choose Airbus. Company is
Okay,
healthier.
give me one reason, or the audience one good reason why you chose Airbus.
The company is healthier. Balance sheet's healthier. Cash flows are healthier.
Yeah.
Basically everything's healthier,
You're taking on less risk.
Yes.
I will stand by that statement all day. Airbus is the less risky play at the present moment, and perhaps it's priced a little bit better, or a little bit more expensive, just a little bit than Boeing. It's just maybe just like a tad bit. They're more or less the same, but I think that Airbus maybe should have more of a premium, because I do think that they're going to surprise us a little bit on the growth rates because of that market share they're potentially going to take. And that's the key word, potentially. But I agree with Austin here. What I'd highlight is the balance sheet is more pristine. They have seemingly, remember from the numbers are telling us a story. When we look at the activity ratios, that the company is commanding more power in the negotiations with their customers relative to Boeing. And I think that Boeing, because of that added balance sheet risk, is going to require, at least for me, a greater margin of safety, because I do not know what that's going to cause in the future in terms of long-term problems. Because remember, we're looking at the stagnant numbers of today and trying to make assumptions about the future, because we invest in the future. So Boeing may have problems investing in the necessary infrastructure or the necessary innovations that Airbus may not have, right? Because they have more options in which to maneuver in terms of their balance sheet. So I think that I think we've covered everything. Again, we would prefer Airbus over Boeing. Do the current prices reflect our assumptions? I wouldn't say that, but I'd say that it's made it to my watch list for sure. Of the two, I'm interested in Airbus. What about you, Austin?
Airbus. And well, you've heard it here, folks.
Wait, are you buying?
Yes.
You got to tell our audience. Are you
buying
Airbus?
I'm not buying Airbus
Are you
yet.
putting
I
on
need
your
to do
watch
more,
list though?
yes, I need to do more due diligence before I buy.
Okay,
Basically,
perfect.
I need to look more into management. I need to look more into some economic risk, industry risks. I need to like actually come up with a, not even like a preliminary, but more so like an educated guess on just sort of how I think that this could potentially recover. And then I have to kind of see the way that the competitors are positioning themselves too.
Wait, Austin, what are you
Competitors'
talking about?
management's also
If stocks go down, they have to come back up.
If they go down, they always come back up.
They always come back up. You hear me, Japan?
Always go up.
They always
So
go up.
actually, as a quick aside, one time I was reading a book on investing, and it literally said exactly that. It was like, when the stock goes down, it will always go back up. Always go up. And then I
Sure,
like,
it wasn't
thought to myself,
stock market. It said the stock.
stock market. It said stock.
Okay.
Yeah.
Well, there's still that problem. It's like someone should tell that to Japan.
Yeah. Well, actually, let's. I know this doesn't exactly have to do with Airbus or Boeing, but since we're kind of going in this direction, why did you just remark with Japan there?
Oh, that's a separate video. That's gonna make this video way too long.
We're leaving them hanging? That's not fair.
Well, then you know what? It gives us it puts us up to task that we have to provide that video one day.
Okay. Yeah.
So
about why stock market, when it goes down, it might not come back up.
No,
Everybody always says it goes up.
It's more like why I have such a problem with some people in the industry saying that's not necessarily the case. That's an assumption, and like all assumptions, they're just assumptions. So no, you're just lucky to live in the time you live in.
Fabio, you are wrong. When stock market go down, it always go back up.
Sure.
Well, folks, you have heard it here first. If you guys have enjoyed what you've seen here today, please be sure to share the video. It really helps out the channel. Please be sure to visit our website at capitalmindset.org. Like, comment, and subscribe. We are your hosts, Austin and Fabio, and we'll see you guys later. Take care.